with Leon and I with Investing Education Academy. So, right now, some of you all may notice in the stock market, it was a recent uptick in the market. We're going to talk about why, and we're going to talk about the fact that is now the time that you should be getting ready to re-enter the market, or should you be taking your money and running the complete other way? Listen to us to find out the results of what we think you should be doing right now. Leon will tell you why we chose this topic, while I'll do a little bit of homework.
Yes. So last time we were on 2 weeks ago, we were talking about generally about kind of what's going with the Fed. We be talking about all year, right? Like we get everyone's tired of hearing about the freaking Federal Reserve. Brent and I are tired of talking about it. However, it's
necessary.
Yes, it's very necessary. It's the only thing really moving the market. Not only the stock market, the bond market, the crypto market, the real estate market, everything right now is being affected by the Fed. So if we don't talk about it, we're actually doing you all a disservice because you're just out here blind, not knowing really what's going on. So today, Mr. Jerome Powell, the head of the Federal Reserve, he spoke at a conference. And he said the words we've all been waiting for. Well, one phrase we've been waiting for. Basically, what that is that they have finally reached a point where they're now going to slow the pace of interest rate hikes. Reason why that's important is because what that means is we're now coming to the tail end of the Federal Reserve raising rates versus the beginning. That is a great thing, and here's why. As we all know, the Federal Reserve has been raising rates, if you've been following us, since November, December of last year.
It started in November, and no, it started just the warning came in November that we gave, and I think December was when you really saw the tick.
Well, the actual, so the effect on the market started in December. The actual first rate hike wasn't until March of the following year. But just by the Fed saying higher rates are coming, it affected the market. But the reason what Jerome Powell said today, which was what he said is that the Federal Reserve is now at the point where they're now going to start slowing the pace of interest rate increases. Reason why that's important because the last 4 rate increases have been 0.75% or 0.75% raises 4 times in a row. The Federal Reserve has never in the history of the Federal Reserve raised that fast and that quickly. And that's why the market has essentially gone straight down over the last year because, again, the market had to adjust to such a rapid remember we always said, when rates rise, there's competition for the stock market, right? Because people have place to put their money. Well, before this, there was no real competition because there was no place to get any yields. Well, since November of last year, we went from zero interest rates to upwards of the 10-year Treasury right now is selling at about you can earn an interest rate of about 3.8%. At its high is about 4.5%.
Yeah, so just so people know, there are investment limits to those bonds.
Yeah, yes, definitely, yeah. But let's just say the 10-year Treasury, over the 10 years per year, you can earn, let's just say 4% per year on your money.
Guaranteed.
Guaranteed. Very good point. Guaranteed. Now remember, in the stock market, nothing's guaranteed, right? As we saw this year, the market is down 20%. So most people lost 20% up to 90% of their money. There's no guarantee in the stock market. If you take that, say $10,000, right now, put it into the 10-year Treasury, you're going to get a guaranteed 4% rate of return on your money. So the stock market now has competition. And the reason Jerome Powell coming out and saying they're going to now slow the increase of rates, means that rates are going to start kind of teetering to dropping a bit. So what's happened, like I said, the 10-year Treasury rate hit about 4.5%, I don't know, a month and a half ago. And the Fed has come out recently and been saying, hey, they've been saying it, right? The federal governors have been coming out saying, hey, we think we're getting ahead of ourselves. We're raising too fast. We don't want to send the economy into recession. And that kind of jawboning has talked rates down a little bit. Now, rates are not going back to zero, right? Those days are over. But 4.5% was probably a little high. I think rates will eventually settle out around between 3.5% to 4.3%, somewhere in that range, over the next year or two. But for right now, it's still in flux because the Fed is still in this raising mode. So say all that to say, the reason this is a good thing is because the problem before was people were like, oh, I need to start buying bonds because these rates are going higher and higher and higher, and they were pulling money out of the stock market, putting it into the bond market for, as Brent said, that guaranteed rate of return. Well, if we know the Federal Reserve is kind of towards the end of their raising rates, and they've said the top end of the rate, the top end for rates they see is 5% on, let's just say, on the 10-year Treasury. I don't think it's going to get to that. I think it's going to be between 4.5% and 5%, but we'll see. That's just my guess, but that's my opinion. So what we know now, we know there's kind of what they call the terminal rate. Rates will probably not get above 5%. I'm just using the 10-year Treasury as an example on the 10-year Treasury. So what does that mean? Everyone now knows, hey, okay, if I want to lock in, let's say 4.5%, 5%, guaranteed you can do that in bonds, or you can go over the stock market and still try to get 10, 20, 30% gains on your money, because everyone knows now once they stop raising rates and they either pause or even cut rates, the stock market is going to rise, right? So now everybody's like, okay, I know my cap that I can get in bonds is about 4.5%, 5%.
Yeah.
But I know over here, now that they've signaled,
also, hey, I want to say again, Leon, just want to reiterate, 4 or 5% with the investment top tier, like you can top out. So
yeah, so I'm saying like the cap, the bond, the cap, the cap or the topping out of returns on bonds that you get, we now know is about, let's just say 5%, right? Guaranteed, but again, that's a guaranteed 5% per year. Now that sounds good. 5% sounds great in a falling market, right? Yeah. So the market right now is down 20% this year. If you can lock in 5% over a year, great, right? But when the Fed says, hey, we're going to pause or we're going to start cutting rates or whatever they say, or even today when they said we're going to start slowing the pace, what happens? The market shoots higher, right? The stock market today was up. S&P was up about 3.5%. Tech stocks were up over 4%. So what all this means is we know, okay, the cap rate that we're going to get in bonds is about 5%. And that's great in a falling market. When the stock market starts to turn, and it will start to turn over the next, say, 6 months to a year, we now know we're going to be back to, on average, 8 to 10% per year in the market with dividends closer to 12%. And then, of course, high flyers or stocks that show solid profits, solid returns, and some tech stocks will do anywhere from 10 to 20, 30%. So that 5% in that light doesn't look that great, right? If you can, you'll take a little risk to get 20% versus locking into 5%. A lot of people. So that's why what Jerome Powell today said was very important, because what he said, he basically told us where the cap is. The most we can make in bonds will be about 5%. So now the market is saying, now people are saying, okay, cool, I'll maybe lock in 5% for the next maybe 6 months or maybe 3 months. But I know going forward now, as the market kind of turns and we kind of get back to quote unquote normalcy in the stock market, they then start to look for their 10, 20, 30% per year. And like I said, the market shot up today on that news. So what Brent and I are saying, and I made this point back in October, I was like, hey, I think we're nearing the bottom of the market, and I don't have a crystal ball. I could be wrong, but so far that's been pretty good call. And the reason I called that was because the signal I saw coming from the Federal Reserve that they were going to start slowing the pace of increases, and I know the market was going to love that. So again, we could test the lows, we may not, who knows? But I just felt that way because where rates are going. Jerome Powell today kind of solidified that rates are going to start slowing. We're not going to see like 7, 8, 9% in interest rates for bonds. 5% be about our cap. So the average 10% per year in the stock market is now looking very, very good. And money's going to start shifting back over to the market over the next 6 months to a year. So Brent and I were saying. So I was saying, what we're saying now is, look, if you've been sitting on the sidelines because the market has been horrific this year, we get it. You want to start putting some money back into the market. Now, we're not saying put it into the high flyers of 2020, 2021. We're saying look at markets like healthcare, financials, insurance, and quality technology. And the reason I named those first three was because they actually benefit from rates going higher. A lot of insurance companies, banks, when you pay your premiums or your money's in, you put your money a deposit in your bank account, all they do is take that money and put it into treasuries and make money off of your money, right? So they benefit from higher rates. And then quality tech. What I mean by quality tech is
quality tech.
Microsoft's, Apple, IBM. Real quick, just it actually surprised me. I got it. So we all remember IBM. IBM has been a trash stock for the past, 10 years, right?
Whoa. In the last 3 years, I've been picking IBM consistently. So
hey, I said 10, didn't say 3.
All right.
I just said I said 10.
All right.
So it's been a terrible stock the last say 10 years, right? I bought IBM I don't know, 2 or 3 months ago, and I'm up like 20+% in the stock in a couple months. And there's a reason for that, right? Because IBM recently what they did was they sold off their legacy, the PC business, and they're focusing mostly on the cloud. But IBM, even the days when they were crap, they were still profitable, right? But the problem was the market wanted to see growth, the high flyers like Apple, Microsoft, things like that, and IBM was penalized for being kind of a slow, dodgy, but with solid
But
profits.
I want to say IBM did pay out a dividend.
They do now, I believe. Let me see.
And during
That's
that 10-year period, they've been a company to pay dividends. I
Yeah.
don't know how consistent it's been, but also too, they're one of the leaders in quantum computing, which is why
that
I
too.
really
Yep. So I got an IBM around 120-ish, and it's up to around 150 now. And even right now at the highs, their dividend is 4.43%. So when I got in a couple months ago, I think the dividend I'm earning is like over 5%. So say all that to say, when we say quality tech, IBM is quality tech, and especially in this environment. It's not a high flyer. It's boring. I mean, they've kind of moved away from the PC game, and now they're more in the cloud. But they're reliable, right? In this market, everyone wants reliable, quality earnings, and they pay a crucial dividend. So that's what I mean by quality tech. Again, I would stay away from the like
Leon,
rogue.
hold on real quick before you go too far away from that.
Yeah.
Think about what Leon said earlier, right? And you're looking at the U.S. bond market. You're getting 5%. Some bonds out there I know are paying 9%, but we're not talking about those bonds right now, right? And so you look at a dividend from an IBM is paying 4%. Plus, Leon just got the bump from the fact that there's been over 20% appreciation in the last few months. You're talking about let's just say it stayed exactly like this for 12 months. I know that's not what we're saying, but let's just for comparison standards. He's going to get the 4% and then the 20% of the growth. That's a net cumulative growth for the year of 24%. And so these things can't happen in the bond market. So granted, your money is secure, but if you're looking at like the I bond or EEE bond, or and also too, it's a difference if you have the I bond electric or if you're buying a paper I bond. Because I think the paper I bond is like $5,000 investment cap. Electronic I bond, don't quote me, I'm going from memory. Electronic I bond maybe 10,000, and double E is 10,000. But in the market, Leon can put as much as almost theoretically as much as he wants into IBM. And so these things are very important when you're looking at how you invest and what direction the market's going in right now.
Yeah, and that's a good point. So kind of going back to what we were saying, we know now, and again, I'm just using the 10-year treasury as an example. The 10-year treasury will top out at, let's just say, at about 5%. We kind of now know that, right? And IBM, when I bought it, I was getting a 5% dividend locked in. Like as long as I'm in that stock at that price, I'll get my 5% into perpetuity. But I also got the 20% gain over the last couple months, right? Exactly what Brent said. So this is why once the stock market turns, 5% return in a bond doesn't look that great, right? Because I can get that in IBM from the dividend loan plus the appreciation of whatever the stock is going to do. Again, 5% looks great in a market that's down 20% right now. I can not going to guarantee it, but I can almost guarantee that next year, 2023, the market will not be down 20% again. And many stocks, I don't know what the market's going to do, but I would guarantee it's not going to be down 20%. I can guarantee many stocks will return way more than 5% you get in a bond right now. And so this is why it's really, really, really important now, again, that we have that knowledge of, okay, 5% basically where bonds are going to top out at. We need to start to put money back to work into the market, but responsibly. Nothing's changed as far as what we're saying. We're still saying buy companies that have quality revenue, quality profits, solid management, products that are in demand. I mean, if you just buy the companies that you kind of know, do your research. Like I always use this example of Walgreens. Terrible stock the last 5 years. You lost 60% of your money in the last 5 years. But everybody knows Walgreens, right? Reliable company. So do your research before you buy. But now, I'm telling you, now is the time to start putting money to work. And over the next 6 to 8 months, you're going to be very happy you did.
Okay, so let's talk about what that means for a lot of you all out there thinking, okay, Brent Leon just told me to run back and put all my money in. No.
Didn't say all.
So that's how people hear it, right?
I know.
And so we're going to very methodically tell you this is when you do dollar cost averaging back into the market. And so you want a dollar cost average, hopefully up. So that means that you're systematically putting in a particular dollar amount on a regular basis to get to some number in the future, whatever your number is for whomever you are. Now, Leon and I always say this, please do not use the money you use for groceries. Please do not take out loans because the market's about to go bananas and I need to be in it. Please do not risk the money for your kids' education. This should be money that is designated for investing, that is designated for you to really, for money to grow. And so it should be discretionary funds of some sort that's on the side. Why is that important? When everybody was running the Bitcoin on the big dip and they thought, okay, Bitcoin is going to run again for, up until 20,000. And it did. But then what happened? It went from 20,000 to 3,000 in less than 4 months. People literally had taken loans out thinking this was going to be the next big thing. And we don't want anybody in our community thinking, oh, well, the market's been down so much, it's going to run. We've also said it's not going to be a rubber band effect. Like this is not going to see the market where it's just all of a sudden back up 40%. This is not 2020, people. And please don't say we didn't tell you because we're taking time right now to tell you. Get used to normal growth. It has been a very abnormal market for the last 3 years, honestly. So where we're headed, more than likely, is going to be a leveling off of the market. It's probably going to stay in this level area, I'm guessing, a few years. And then there'll be some other event that comes up and it'll shake the market. But normally, just stay the course with money that you can afford to lose. Make sure you have an investment strategy that works for you. And if you don't have one, if you never thought about it, join Investment Education Academy. Get a membership. We're putting out notices all the time. We can answer questions if you have questions. But this is the moment where you really want to think about what you're doing to get back into the market or reposition yourself. Or for all of you all, you know who you are, who just put your head in the sand up until this point and you haven't looked at your accounts. If you have some dogs in your portfolio, like some of those SPACs, some of those
IPOs.
I was just so I know some of you all thinking, oh, well, since the market's coming back up, I'm gonna wait for the IPOs to come out. That's never been a good strategy ever. And it more than likely it's a losing strategy, so don't do it. So if you're looking at getting back into the market, don't wait for SPACs. Drop them if you have them. And I know that's a blanket statement. Do your research. Check to see how it's performing. More than likely it's not doing well. SPACs, stay away from them. Special acquisitions company. What's SPAC stand for, Leon? Special purpose acquisition company. So for those of you all what's a SPAC? Special purpose acquisition companies. We are not big proponents of them at all. Look for companies like Leon said earlier. I won't repeat it, but I just wanted to make sure we consolidated that thought for you all before we jumped off.
And I got an example, kind of what Brent was talking about, right? So, just because 2020, 2021, the market went crazy, right? We all loved it. We were making money hand over fist. We were printing money, right? People are now, because I've talked to them, I'm sure Brent has too. Some people are looking at the market and saying, okay, if a stock was at, hypothetical numbers here, if a stock was at 300, but right now it's at 100, that's a great buying opportunity because it has to go back to 300 because it was there before, right? Not the case. Here's an example. Back in the dot-com bubble of the late 90s, early 2000s, Cisco Systems was one of the largest companies on the planet at the time. At the time, it ran the internet. It was a networking products that the internet was built on. Cisco was it was like 2020, 2021, you could print money on it. Its all-time high in year 2000 was $82. Cisco has never, ever gotten back to $82. Cisco, again, the internet was built on Cisco. If you go back and look at some old articles, Cisco was the Amazon, the Google of its time. It was the monster. Easy print money. Cisco has never returned to $82 in 22 years. So just because a stock was at a high over the last couple of years doesn't mean, oh, I should buy now because it's quote unquote cheap because it has to get back to $300 or whatever number is. That is not the case. Yep. A lot of what happened in 2020, 2021 was abnormal. That was an inflated market based on ridiculous stimulus that we all needed. The pandemic, we get it. But a lot of that was a falsehood. It wasn't real. So don't look at something just because it's cheap, quote unquote cheap. It's not at an all-time high that it has to get back there. Don't think like that. Do your research, understand what you're buying, and do not base it on a recent high that a stock was at, because that recent high was probably should have never been there in the first place.
Yep. So with that being said, we owe you all 2 stock picks. So we will put that into the group as all of our stock picks go now. And if you're interested, you know what? The market's changing. I do want to get more information on what's happening. Honestly, it wouldn't even matter. Even if the market was continuing to do poorly, you should still want information. Actually, you should probably want it more when the market's performing poorly. But please become a member of Investing Education Academy. You can go to www.ieanow.com. We look forward to growing the membership in 2023. And with that being said, we will see you all in 2 weeks. Have a good day.